Welcome to my channel. I'm glad you're here, especially on this very important and somewhat complex topic. My name is Darius, and as a private investor, I know firsthand how much taxes can eat into your profits. Today, we're going to dive deep into the world of stock investing and discuss a topic that every investor should understand: the tax differences between investing as an individual and as a corporation in the United States. Should you form an LLC or corporation to save on taxes? What are the pros and cons, and what does it look like in different states? Stay tuned because we have a lot to talk about.
Insights for the informed investor.
Segment 1. Basics of taxation in the USA. Let's start with the basic tax rules in the U.S. If you hold and sell stocks as an individual, you will primarily be taxed at two levels: the federal level and possibly the state level, depending on your residency. At the federal level, there are two types of capital gains: short-term and long-term capital gains. Short-term capital gains occur when you hold a stock for less than a year and are taxed at your ordinary income tax rate, which ranges from 10% to 37%, depending on your total income. Long-term capital gains apply to shares held for more than 1 year. They have lower tax rates: 0%, 15%, or 20%, depending on your taxable income. For individuals earning up to $44,625 as of 2023, the tax rate is 0%. If they earn between $44,626 and $492,300, the tax rate is 15%. Above $492,300, the tax rate is 20%. In addition, there is the net investment income tax, NIIT, of 3.8% on capital gains and dividends for those whose modified adjusted gross income exceeds certain thresholds: $200,000 for individuals and $250,000 for married couples filing jointly. Segment 2. Taxation as a private investor. Let's take a look at the details of taxation as a private investor. If you buy and sell shares as a private individual, you will pay either short-term or long-term capital gains tax on your profits, as we have just discussed. Short-term gains. If you buy and sell a stock within a year, the gain is considered a short-term capital gain and taxed at your ordinary income tax rate. So, if you have a high income, these taxes could be as high as 37%, plus the NIIT if applicable. Long-term gains. If the holding period exceeds 1 year, the gains are considered long-term capital gains. Here you have an advantage. The tax rates are lower and favor long-term investments. For example, if you buy shares for $10,000 and sell them 2 years later for $15,000, you will pay between 0% and 20% on the $5,000 gain, depending on your income. Another consideration as a private investor is the tax on dividends. Dividends are classified as qualified or non-qualified dividends. Qualified dividends paid by domestic or qualified foreign corporations are also taxed at the more favorable long-term capital gains rates. Non-qualified dividends, on the other hand, are subject to the higher ordinary income tax rates. Restrictions for private investors. A major disadvantage for private investors is that losses are only deductible to a limited extent. You can claim up to $3,000 of net losses per year against other income, but any losses in excess of this must be carried forward to future years. Segment 3. Taxation as a company, corporation, or LLC. Now let's move on to investing as a business. There are different corporate structures you can use to invest in stocks, mainly the C-Corporation, the S-Corporation, and the Limited Liability Company, LLC. C-Corporation. A C-Corporation is a separate legal entity and pays corporate income tax on its profits. The corporate tax rate is currently 21% at the federal level. If the C-Corporation pays dividends to its shareholders, the shareholders must also pay capital gains tax on those dividends. This results in what is known as double taxation, where both the company and the shareholder are taxed. Advantages of the C Corporation. Despite the double taxation, the C Corporation has advantages. For example, profits can be reinvested in the business without being taxed immediately. This is especially useful if you want to use the profits to further invest in the company instead of distributing them. S Corporation. An S Corporation offers a way to avoid double taxation. Profits and losses are passed through to shareholders and taxed only at the personal level. However, there are limitations. For example, an S corporation may only have a limited number of shareholders, and they must be U.S. citizens or residents. LLC, Limited Liability Company. An LLC offers flexibility and can be taxed either like a partnership or a corporation. In most cases, the LLC is treated as a pass-through entity, which means that profits are passed through directly to the members and taxed at their personal level, avoiding double taxation. A major advantage of the LLC is the flexibility in taxation and the ability to limit personal liability. In addition, LLCs can change their tax classification and be treated as a C corporation if this is more advantageous for them. Segment 4. Advantages of taxation as a company. Why should you consider investing as a business? Here are some of the key benefits. 1. Reinvestment of profits. Businesses, especially C corporations, can leave profits within the company and use them for future investments without being taxed immediately. This offers significant growth opportunities for your portfolio. 2. Deductible costs. Companies can deduct a variety of business expenses that are not deductible for private investors. These include salaries, rent, office expenses, and health benefits. These deductions can significantly reduce taxable profits. Third, offsetting losses. Companies often have more flexibility in utilizing losses. Losses can be carried forward to future years to reduce future profits and thus lower the tax burden. Fourth, tax-free distributions. With S corporations and LLCs, there is the ability to make tax-free distributions as long as they do not exceed the basis of the investment. This can be an interesting way to pull money out of the business without having to pay taxes immediately. 5. Capital structures and financing. Companies can raise capital more easily, whether through debt or equity. They can issue shares to finance investments and thus accelerate growth. Segment 5. Differences in taxation between the states. Now it gets really interesting, taxation at state level in the USA. Each of the 50 states has its own tax laws, which can vary considerably. Some states, such as Florida, Texas, and Nevada, do not levy state income tax at all. In these states, it may be more advantageous to invest as a private individual, as capital gains are only taxed at federal level. In states like California or New York, on the other hand, which have high state income taxes, the tax burden can be significantly higher. For example, California levies up to 13.3% on top of the federal capital gains tax, which means you could pay over 33% in total on long-term capital gains. Another factor is the different tax rates for corporations. Some states have lower corporate tax rates or offer specific incentives for certain types of businesses. For example, a C corporation in a state with low tax rates or specific tax incentives could benefit from significant savings. There are also differences in the taxation of dividends at the state level. Some states tax dividends the same as ordinary income, while others favor them or don't tax them at all. This can be an important factor when deciding whether to form an LLC or a corporation in a particular state. Segment 6. When is it worth setting up an LLC or corporation? Let's get to the crucial question. When is it worth setting up an LLC or a corporation? If you live in a high-income tax state and plan to invest large sums of money, an LLC or corporation could be very beneficial. By using an LLC, you can potentially save on taxes while benefiting from liability protection. If you want to reinvest profits in the business and grow over the long term, a C corporation might be a better choice, as it allows you to accumulate profits internally and use them for future investments without incurring high taxes immediately. On the other hand, if you mainly want to pay out dividends and avoid double taxation, an S corporation or LLC might be better as a pass-through entity. It's also important to note that the administrative requirements and costs of forming and running an LLC or corporation are higher than simply investing as an individual. Therefore, it is important to weigh the potential tax benefits against these additional costs. Segment 7. Conclusion and recommendations. Let's summarize. Investing in stocks can offer tax advantages both as an individual and as a business, depending on your personal situation, where you live, and your investment goals. If you live in a state with high income tax and plan to invest larger sums, an LLC or corporation might make more sense, especially if you plan to reinvest profits. If you live in a state with no income tax, the benefits may be less. My recommendation: talk to a tax advisor before making a decision. Thorough tax planning can help you save thousands of dollars and reach your financial goals faster. If you like this video, give it a like, subscribe to the channel, and activate the bell so you don't miss any more videos. Thanks for watching, and see you next time.